Hello, my friends. Today is December 9th, and this is Markets Weekly. So, this week we got some pretty interesting developments in markets, so we have a lot to talk about. First, let's talk about the labor market. This past week, we got JOLTS data and we got the very important non farm payrolls report. Let's discuss what those reports are saying about the labor market. Secondly, now the market has for some time been anticipating a quote unquote ECB pivot. This past week, a senior ECB official gave an interview that seems to suggest what the market has long suspected that maybe the pivot is in and the ECB rate hike cycle is over. And lastly, let's talk about another pivot happening. Now, we know central banks around the world have been pivoting, but they're not all pivoting in the same direction. We got some reports that the Bank of Japan may finally be willing to hike interest rates. Let's talk about what that means for global markets. Okay, starting with jobs data. So this past week, we first got the JOLTS report. So JOLTS basically shows the number of job openings in the US. Now, the JOLTS data itself shows a significant decline in the number of job openings. Now, you might think that that is a bearish development, but if you zoom out a bit, you'll note that the amount of job openings in the US right now is far above levels that prevailed before 2020. So it seems like the job market is cooling, but it's merely going from super hot to modestly hot. And this is actually squarely in soft landing territory. Now let's rewind a little bit. So, a year or two ago, the economy was roaring hot, inflation was skyrocketing, and wages were red hot as well. The Fed hiked interest rates, trying to get inflation down, in part by cooling the labor market. The Fed was thinking that if the labor market cooled down, wage growth would moderate and maybe inflation would come down as well. Now, one way the labor market cool is if we have a rise in unemployment. That's what has happened typically in the past. So the playbook would be Fed hikes rates, economy slows, unemployment rate rises, and wage growth comes down. But that's not the only way this could happen. Another way this could happen is simply that demand for labor moderates. For example, let's say you have a worker and he gets 10 job offers. Well, obviously, if 10 companies are bidding for his services, then there could be a bidding war and wages will grow at a fast pace. But let's say in that same scenario, instead of 10 companies bidding for a worker, let's say the worker only has 5 companies bidding for his services. In that case, well, the worker still remains employed, but maybe he doesn't have as large as amount of wage growth. And that seems to be what's happening right now, as suggested by the JOLTS data. Again, the economy is slowing, but the labor market, of course, remains uh, much hotter than it was before 2020. So far, squarely in soft landing. And this is consistent with what we saw in the non farms payroll report, which suggests a strong labor market. Now, when we look at the NFP data, there's a few things we want to focus on. First, of course, what everyone focuses on is the headline number. We got 199,000 jobs created, a bit above expectations. Now, as an economy, we need about 100,000 jobs growth per month to meet the increase in our workforce. So 199,000 is comfortably above that. Now, where are the 99,000 people coming from then? Well, that brings us to our next focus point, the labor force participation. In this report, we clearly see that labor force participation continues to increase. That means there are more people willing to work, increasing the supply of labor. That again is good for the economy, as when you have more people working, you have more growth. Now, why are more people participating in the labor force? Well, that could be because wage growth remains solid. So, the third thing we want to look at is the growth in wages. Growth in wages, 4%, is higher than expected and elevated compared to pre 2020 trends. So, again, this still suggests that there is strong demand for labor. After all, After all, wage growth remains comfortably above pre 2020 trends, and also now that inflation has come down, wage growth is above inflation. Now, the last thing we want to focus on in this non farm payrolls report is the unemployment rate. Now, there's a lot of people paying special attention to this because of something called the Sahm rule, which is a rule created by Claudia Sahm, a former economist at the Federal Reserve. What Claudia noticed was that there seems to be momentum in the unemployment rate. So when the unemployment rate trends higher, it tends to continue to move higher. So she looked at this empirical observation, created some calculations, and under her rule, when the SAM rule is triggered, historically speaking, the economy is always in recession. So if you look really closely at the unemployment rate over the past few months, you notice that the unemployment rate has been gradually trending higher. So a lot of people were focusing on this at this report, thinking that if the unemployment rate continues to trend higher, well, that means the SAM rule is going to be triggered quickly, and then the economy could be in recession. Again, there have been many, many people who have been watching for recession for 2 years, and that just doesn't seem to happen. And based on this report, it looks like it's going to be some ways away as well, because in this report, the unemployment rate actually ticked lower. So under the SAM rule, um, the recession is going to be farther away than expected. And indeed, as we've been discussing, economic growth is solid and wage growth is solid as well. And in this week's blog post, I will write about taking a deep dive into credit. Credit looks solid as well. So, all in all, there doesn't seem to be any indication of recession. Of course, we will have a recession. It's like death and taxes. It will eventually come, but right now it doesn't seem to be close based on what I see. Okay, now the next thing I want to talk about is the quote unquote ECB pivot. Now, the market, looking at market pricing, has been suggesting that the ECB is probably done with their rate hikes. The market has seen that the Eurozone is probably in recession, their growth numbers have not been good, and inflation has coming in lower than expected. So, based on that logic, it seems like the ECB shouldn't be raising rates anymore. Now, that's what the market has been expecting, and we know this by looking at short term interest rate futures. And this week, we seem to finally get confirmation that that is indeed the case. Isabel Schnabel, a very senior ECB official and someone who is doing a very good job, uh, gave an interview this past week with Reuters, and she opened up with the memorable line from Keynes that when the facts change, I change my mind, which is how we should all behave. Now, it seems like she is looking at the data, and inflation data has been coming in softer than expected. That means progress on inflation has been better than expected. The implication, of course, is that the ECB most probably is done with its rate hike cycle. And so now the focus has to be when are they going to cut rates? Now, the market has been pricing in rate cuts, sometime several months away. After this interview, they priced in a slightly more dovish path of policy. But that definitely is the focus now, and you can see that being reflected in market pricing. Most obviously, let's look at the Euro USD exchange rate. Over the past few days, you can see that the euro seems to be losing momentum and seems to be weakening against the dollar. The market priced in aggressive Fed cuts, and now it's beginning to price in some ECB cuts, and these two are having somewhat of a balancing impact. But that's not the only place we can look to see the impact of anticipated rate cuts. We can also look in Eurozone risk assets, for example, the DAX, which is the German stock market index, or the CAC, the French stock market index. When you look at these indexes, it looks like they are going to the moon. After all, it looks like we are embarking upon a rate cutting cycle across the world, and rate cuts are something that risk assets like. From my observation, the biggest driver of financial assets is central bank policy. So, if the central banks across the world are signaling rate cuts, then that's obviously positive for risk assets abroad as it is in the US. Um, but actually, not all central banks are actually in on the rate cut bandwagon. which brings us to our last topic. The Bank of Japan is actually thinking about going in the opposite direction. There's reporting that suggests, based on a recent interview from Governor Ueda, that he's thinking of hiking rates in the near future. Now, just for some perspective here, over the past couple of years, the Federal Reserve hiked rates aggressively, hiked comfortably above 5%. At the same time, though, the Bank of Japan still comfortably negative. So the inflation washed over the entire world, including in Japan, and inflation in Japan has been comfortably above the BOJ's target for some time, but they have kept interest rates negative. Now, the market has been anticipating, based on swaps, that the Bank of Japan is going to be lifting their interest rates. So, sometime next year. And this recent interview seems to have strengthened that expectations. And we can see that reflected immediately in market pricing. So, if you look at the USD JPY, the exchange rate between dollars and yen, you can see that the release of the news resulted in a discrete 2% appreciation of the Japanese yen. And of course, if you look at the Japanese bond market, 10-year JGBs rose significantly at that news. So that makes total sense, of course, right? When the Bank of Japan is thinking of hiking rates, well, you got to price that. That means the yen is going to strengthen, and of course, that means that yields go higher. Not rocket science. But of course, many market participants have been paying particular attention to this because it's commonly thought of as the yen as a major funding currency. So there's a couple ways you can think about this. So if you are a giant foreign investor and you're investing all over the world, let's say you want to borrow money. Where should you borrow money? Well, across the world, uh, in Japan, rates are negative. So it makes sense to borrow a lot of money from Japan, convert that to dollars or euros or wherever you want to invest, and then use that to buy non yen denominated assets. You can also say the same thing about Japanese investors. Let's say you're a giant Japanese insurance fund. You have a whole bunch of yen you need to invest, but you don't want to have negative rates and you don't like to have super low rates. Instead, then you take that money, you convert it into dollars, and maybe buy treasuries or agency MBS. So, if the yen is a major funding currency for assets for investors across the world, when the Bank of Japan raises interest rates, that could potentially be destabilizing. It could be destabilizing. One is that, well, maybe interest rates go higher in Japan. Maybe my trade doesn't work anymore. And so I sell my foreign assets to repay my yen loans. One source of instability. Another source is that as interest rates in Japan rise, maybe the Japanese yen appreciates a lot, and so I'm sitting on a lot of foreign currency, a lot of currency losses. So, for example, let's say it's widely reported that Japanese life insurers have been buying foreign assets on an unhedged basis. So, let's say you're a Japanese life insurer. Let's say you bought $1 billion worth of U.S. Treasuries. Now, you did not hedge the currency risk. And so you basically took a lot of yen, you sold it, bought dollars, and bought treasuries. Now, over the past 2 years, this trade has been killer because you've been getting higher interest rates on treasuries, but at the same time, the dollar has appreciated against the yen significantly. So you've made money on the currency side. However, if the Bank of Japan is raising interest rates, maybe the yen strengthens and you end up losing on the currency side. And you did, because of course you didn't hedge your currency exposure. And based on Bank of Japan data, indeed, it seems like fewer people are hedging their currency exposure. So maybe because you're losing money on the currency side of your trade, you get out of a trade. So you sell the treasuries, sell the agency MBS or corporate bonds or whatever it is you're holding, and you repay your yen loan. So there is a possibility that increases in the Bank of Japan's policy rate could, through higher interest rates and the stronger yen, have some deleveraging impact on asset markets abroad. So far, though, of course, you don't see it. And indeed, I think it's important to note that although the Bank of Japan is hiking interest rates, they're probably going to go from negative 0.1% to 0%. Um, the interest rate differential between the yen and the dollar and the euro and other currencies remains very large. So I would expect the Bank of Japan to be moving very cautiously and to do this in a way that's not going to be destabilizing. They will, for certain, be in close contact with other central banks. So I think so far that this is something that is well understood and it will be managed carefully. Bank of Japan has shown that they are able to do this. Remember, they gradually lifted the yield control curve band, and things seem to have been working well. So I'm not too worried about this. Okay, so this week we have a Fed meeting. So I will be back after the Fed meeting to give you my thoughts. My base case is that this is going to be uh, interpreted as a dovish meeting. It's not going to be as dovish as priced into the interest rate futures markets, but I think that the equity market would interpret it as dovish. So that's my expectation. All right. If you like what I'm producing, remember to like and subscribe. And of course, if you're interested in my latest market thoughts, check out my blog, fedguy.com. And if you're interested in learning more about macro markets and major asset classes, check out my courses at centralbanking101.com. Thanks so much, and I'll talk to you guys really soon.